Hey, my wonderful taxpayers. This recording is to explain a great strategy called a leveraged charitable deduction. So you're either working with me directly or with your tax professional to get this strategy implemented in your tax plan. So we're going to share this with you. I'm going to talk to you about it so that you understand exactly what this strategy is and how it will affect your tax return. I'm going to even share an example with you of a client who tried it last year and was able to save, a lot of money on taxes, and we'll show you what that looks like. So this leveraged charitable deduction is where we're donating as taxpayers. We're actually participating in an LLC that is doing the donation. This LLC is created with other members, and you're participating on a limited basis, right? You're a limited liability partner. We all put up a certain amount of money and purchase this mineral, and that's considered property. And once we donate this property, because we're all electing to donate this property to a recognized 501c3, the 501c3 then turns around and donates it at fair market value. So we're buying in bulk, we're donating it at fair market value, and then you're going to see the impact on your tax return. Now, in this particular example, in previous years, we've had, magnesium, donating for breast cancer research to a 501c3 that does charitable work on the breast cancer research. The following year, it was for stroke research. This year, it's volcanic ash, a mineral that we're choosing this year to donate. A taxpayer can generate a tax deduction against the ordinary income equal to 4 times the cash outlay. So here's an example of how it can look. This particular, on $1 million worth of income, this taxpayer is saving $250, as in this pro forma of a California tax return. Here's the estimated ordinary income. Because it's property, it's limited to 30% of that, right, of the AGI. And then here's the suggested maximum purchase. So if the taxpayer puts up $75,000, right? 4 times that is the 300. And see, these are his marginal rates and after tax net income. And that's his cash benefit. And it's based on long-standing rules related to charitable giving and long-term holding rules. It is not a listed transaction under current IRS pronouncements. So it's relatively safe. In other words, not likely to be audited and accepted. So what that means is the charity is a qualified charity. So the IRS, the IRS recognizes as a 501c3 and making the contribution eligible for the deduction. So this charity is going to use donation it receives to further their charitable purpose. So they actually have their 501c3 very distinguished and already explained and described, and it's in line with what their mission is. And they're reselling it for donations of cash. So the charitable deductions available on donations made to these qualified charities up to 30% of the ordinary income per year and can be carried forward for up to 5 years. So if you, by chance, your income ended up being lower than you thought, then you'll just carry forward the rest. The donations to charity are at appraised fair market value when held for over 1 year. Now you're going to say, hey, I just started this LLC. How am I already 1 year holding this asset? And I'm going to show you that. So the holding period of the assets contributed by the LLC member are tacked on to the holding period of the entire LLC. So we've already had this LLC established, right? And we have older members holding this asset. So thus, it's held for over a year by the contributing partner and deemed to be held long-term. So deduction in excess of basis is allowable. I want to make sure you understand that. So determining the partner's holding period is section 1223.2 provides that partnership's holding period for contributed assets includes the holding period of the assets in the hands of the contributing partner. This tacking on concept applies whether or not the contributing partner recognizes any gain on the contribution because of a net reduction in liabilities. And again, we have further information explaining It's not a listed transaction, and it's not substantially similar to this conservation easement getting audited all the time. It clearly states that conservation easements are based on inflated hypothetical valuations. In addition, and in contrast to traditional charitable giving, where an asset is put into productive use for the benefit of a charity, in conservation easements, the charity is yoked with the burden of enforcing the easement. So this goes against typical public policy, encouraging the productive use of assets, and the specific congressional intent of Congress that charities receive the benefit of donating assets to actively further their charitable purpose. So it's not staying within the charity, is what we're saying, right? It's going out for the purpose. This is a letter from the lawyer is every year puts out his opinion on this. So he sends you this to the purchaser, which is you. You have asked my opinion as to the income tax consequences of a contribution of volcanic ash this year. As described in the series of transactions below to a 501c3 tax-exempt public charity in December of this year, in this case, your question is if this donation qualifies for a charitable contribution deduction equal to the fair market value of the fertilizer donated. In this case, it's the volcanic ash. I have reviewed the Volcanic Safeguard Holdings Series LLC documents and other documents, and had email and telephone exchanges with you and your CPA. So in our case, we're in contact with a lawyer. Based on the following assumptions, qualifications, and analysis, I believe that is more likely than not that a charitable deduction will be allowed for your contribution donation of the fertilizer at its fair market value. Based on the information provided to me, I understand that the transaction, or more precisely, series of transactions, consisted of the following. We contributed, and in this case, $150, and a partnership for tax purposes. You did this through your single member LLC, which we create for you. Well, the attorney, because we're only accountants. And your LLC became a partner with this holdings in a certain series. And then you're going to vote, and we'll give you all the paperwork for that, to have Series 20 donate the fertilizer, because we don't want a bunch of volcanic ash in our driveway and so forth. So we can give you all the documentation that supports what this is. At the end of the year, actually the following January, when everything is said and done and the 1065 is filed, you're going to get a K1 showing the contribution amount, the 4 times, and that's going to go on your Schedule A. And that's where you're going to claim that deduction on property. We'll also give you the backup on the fair market value, the appraisal that was done on the volcanic ash, to support in case of any audit. You have all that ready to go. I'm going to show you a tax return that we did last year with the results from deducting. And I just want that to be crystal clear. So the step-by process looks like this. You're going to sign up with your advisor. You're going to wire the money as the attorneys establish, right? You're going to work out with them. The documents are there that you're going to be signing, everything through Adobe or so. We're going to vote by 12/31. We have to vote to get rid of this volcanic ash to the respective charity. And then you do your tax return with the K1s. The commercialization of volcanic minerals continues under the direction of pre-designated commercialization partner, the charity, either in concert with the charity and or with the individual directly according to their vote. Okay, so that's the step-by-step process. By the way, at the end of the year, like after you file your taxes and so on, the IRS may send a notice because this will be a final K1. And so the IRS might say, hey, let me just double check for identity purposes. You want to make sure that, yep, I'm dissolving it, and they're just going to ask for a verification. So you may get a letter on that, and we'll help you at that time when that letter comes. I just don't want to overwhelm you. Now, here's an example of a tax return prepared where this particular taxpayer, the total income was $508,000. Well, actually, I want to show you without it first because it's just more interesting to see it without, right? So he's at the 504, and then he can itemize. In this case, this taxpayer was able to itemize. His taxable income was $468. His tax liability $109 on that $468. And by the time he finished, he still got an overpayment, and so he had a refund of $1,350. With the LCD, he's now able to itemize. He put up $25,000. 25 times 4 is $100,000. So his Schedule A ended up being a little higher, right? If you jump back to this one and we look at the Schedule A, we'll see he was only able to do the mortgage interest. Gifts to charity was only $1,655, and he was able to itemize $35,228. Over here, his Schedule A looks like this. And now he has, other than cash, adds the additional $100,000. And so now his taxable income is $360,700. Tax due on that is $73,000. All right, remember it was $109. Looking at everything else, and his refund ended up being $36,959. So you may say, oh, he gave up $25,000, but see, he gets the $25,000 back plus the additional refund, because it's not a dollar for dollar transaction. So that's what you want people to understand. It is not a dollar for dollar credit. That's what credits are. A deduction just lowers your taxable income, which I think is still pretty good. And you're charitable. You're giving something to a great organization that's going to be doing great things for its